Okay, let's talk about your money. Specifically, that cash you've got just sitting in a savings account. Is it doing anything for you? Today we're going to look at a really powerful tool, one that's often overlooked, that could be a much smarter place for your idle cash. You know, when we think about stashing cash away safely, what's the first thing that comes to mind? For most people, it's a fixed deposit, right? It's the default. It feels safe, it feels familiar. But here's a question. What if that safety is actually costing you in returns? Let's dig in and see if there's another option out there, one that gives you a little more bang for your buck without a ton of extra risk. Well, the answer might just be something called short-term bills. Now, you might not hear about these as much as, say, stocks or bonds, but trust me, they are a cornerstone of the financial world for a very good reason. So, let's break it down. What exactly are they?
Okay, at their most basic level, you can think of short-term bills as just simple IOUs. Seriously, a big corporation or even the government needs some quick cash, maybe for a short-term project. So they issue these bills to borrow that money. For you, the investor, it's a really stable place to park your money for less than a year. And people in finance love to say they're highly liquid. And all that means is that it's super easy to turn them back into cash whenever you need to.
Okay, that sounds simple enough, but how do you actually make money from them? The best part is, the way you profit is surprisingly simple. You don't need to worry about any complex interest calculations. Let me show you how it works.
It all comes down to something called the discount issuance method. Sounds fancy, but it's not. Imagine a bill has a face value of, say, $1,000. The trick is, you don't actually pay $1,000 for it. You buy it at a discount, maybe for $990. Then, you just hang on to it until its maturity date, and when that day comes, you cash it in for the full face value of $1,000. That $10 difference? That's your profit. It's really that simple. Now, it's important to know that not all bills are the same. The biggest difference between them is simply who is issuing them. And knowing who's behind that IOU is pretty much the key to understanding what you're buying. So, you've basically got three main players here. First up, there's commercial paper, or CP. These come from big corporations that need some quick funding. Next, you have negotiable CDs, or NCDs, which are issued by banks. And last but not least, you've got Treasury Bills. You'll hear people call them T-bills. These are issued by the government, and they're pretty much considered the gold standard for safety, the ultimate risk-free investment.
All right, so now we know what these bills are and how you make money from them. Which brings us right back to that first question we asked. Why on earth would you pick one of these over a good old-fashioned fixed deposit? Well, the reasons are actually pretty compelling.
It really boils down to this powerful three-part combo. They're super safe, they're really liquid, and they often offer better returns. So let's put them head-to-head with fixed deposits and see how they really stack up. First off, returns. The rate you get from a short-term bill is often just a little bit higher than what you'd get from a fixed deposit. But honestly, the real game changers are liquidity and taxes. See, with a bill, you can usually sell it anytime you want without getting hit by those nasty early withdrawal penalties. That's a huge piece of flexibility that fixed deposits just don't have. And then there's the tax situation, which is a whole other level of advantage. But hang on, before we get into the tax benefits, let's just double-click on safety for a second. Because look, if you're used to fixed deposits, safety is probably your #1 concern, right? And that's fair. The crucial thing to remember here is that these instruments are heavily regulated. They're usually guaranteed by banks or backed by the full faith and credit of the government. This means the credit risk, the risk that you won't get your money back, is extremely low. Okay, now for that tax advantage I've been teasing. This is huge. For a lot of investors, and I'm talking especially to those in higher income brackets, this is where short-term bills go from being a good idea to an absolutely brilliant one. The magic number to keep in your head here is often around 10%. Why? Because the profit you make from these bills is often taxed at a separate, flat rate, like 10%. Now think about your fixed deposit. The interest you earn there just gets piled on top of your regular income and gets taxed at your highest marginal rate. If you're a high earner, that could be a huge chunk. The difference between a flat 10% and your top tax rate can mean a lot more money staying in your pocket. Okay, so we've covered the what and the why. Now let's get practical and talk about the how. I want to share a really smart but simple tip for how to invest in these bills.
The whole strategy really boils down to this. Pay attention to what interest rates are doing. If you expect rates to go up, then you want to stick with shorter-term bills. It's that simple.
And here's the logic behind that. If you invest in bills with really short maturities, I'm talking 30, 60, maybe 90 days, your money isn't locked in for very long.
As soon as that bill matures, you get your cash back. And what can you do? You can immediately turn around and reinvest it into a brand new bill at those shiny new higher interest rates. This whole strategy is about keeping your capital flexible so it can work as hard as possible for you.
So when you put it all together, what do we got? Short-term bills offer this amazing mix of safety, incredible flexibility, and much smarter, tax-efficient returns. They're a way to put that idle cash to work, to wake it up, without locking it away for ages. So the final question to leave you with isn't just whether this is a good option. It's this: is your capital ready for more flexible use? Just think about how much more your money could be doing for you, starting right now.